Hey, it's Kevin here. So it's tax filing season again, and the good news is this time the deadline is a month later than usual, May 17th rather than April 15th. The bad news is that filing your taxes is still a very manual process, and it still takes a whole bunch of time to get all the tax breaks you qualify for. In today's video, I'm covering tips that can save you up to $500,000 from your 2020 taxes with a special focus on new tax breaks, credits, and deductions introduced this year. Use free tax filing software. This is an easy one. Everyone knows about TurboTax, but not everyone knows that TurboTax also offers a free version of their software for people who make less than $39,000 a year or $72,000 if you're active duty military. Actually, TurboTax is required by federal law to offer this, so it's not exactly out of the goodness of their hearts, but it exists. TurboTax doesn't exactly make their free offering easy to find, so I've added a link to their free filing software in the description down below. There are other services that offer free tax filing, even if you make more than that $39,000 limit. Two that you can consider checking out are Credit Karma and Free Tax USA. You may know Credit Karma best for checking your credit scores or finding your recommendation for that new credit card. But in the last 2 years, they've rolled out free federal and state tax returns. Free Tax USA, on the other hand, has been around for a while. They've helped file over 43 million tax returns to date. The downside to them, though, is that while federal tax returns are free, you're going to have to pay for those state tax returns. I'm not recommending either service specifically, since I don't use either of them personally, but I just want to make sure that you know you have options. Using free software for filing your taxes saves you about $100. Maximize tax deferred savings. Whether it's your 401k, Roth IRA, or other savings vehicles like health savings accounts, HSA, or 529 education funds, for many people, it makes sense to put away money for future use. I've said it before in one of my earlier videos, it makes sense as a general recommendation to save money because people are usually pretty bad at planning and saving. So if you're going to put money into these funds that have limitations on access, then at least it makes sense that you should try to make it tax deferred or tax deductible. You can put up to $6,000 in your Roth IRA, $18,000 in your 401k, and $15,000 in your 529, as well as $3,500 into your HSA. Double those numbers if you're married and filing jointly. That's a maximum of $43,000 of deferred tax dollars. So at a 30% tax rate, that's over $13,000 in tax savings. Itemize your deductions. Probably the biggest single thing you can do is itemize your deductions. There are probably hundreds or thousands of items that you can deduct, so I can't possibly go over every single one of them in this video. But just know that the more money you make, the more likely itemizing deductions is going to benefit you. The standard deduction ranges from $12,400 to $18,500, depending on your tax filing status. But there's so many more things you can deduct. You can deduct your interest from student loans, money you pay towards your tuition, childcare expenses, interest paid on your mortgage, and tons more. One thing to note is that you unlock many more deductible items if you were self-employed, ran a business, or just had a side hustle in 2020, like me with my real estate investing and this YouTube channel. For example, even though I worked from home last year as a salaried employee, I wouldn't be able to deduct my office expenses from that job. But since I also ran these other businesses, I can deduct not only my office expenses, but my rent, my utilities, the filming equipment that I bought, my laptop, health insurance premiums, office supplies, phone and internet expenses, car insurance, gas, and so much more. Normally, travel and food would also be big ticket deductions for businesses, but that didn't happen that much in 2020. If you ran a large business, you could easily have hundreds of thousands in deductible expenses. It's easy when there's stuff like being able to write off 50% of your new vehicle purchase if it's over 6,000 pounds. That's why trucks, G-Wagons, and Tesla Model X's are popular choices for these successful and wealthy individuals. For me, I end up often having about $20,000 to $40,000 of deductible expenses, saving me $5,000 to $10,000 of taxes versus using just the standard deduction. Take advantage of tax credits. The difference between tax deductions and tax credits is that deductions reduce taxable income, while credits reduce taxes. So if you made $100K, a $5,000 tax deduction at a 25% tax bracket reduces your taxes by $1,250, whereas a $5,000 tax credit would reduce your tax bill by $5,000. Tax credits to take advantage of include credits for student loans, paying your college tuition, for making less than a certain amount of income, contributing to your retirement savings, installing solar panels, buying electric vehicles, and more. And yes, the US government really wants you to both go to college and pay back your student loans, so much so that they'll give you credits and deductions for doing these two actions. COVID-specific credits include reducing your taxes if you took sick or family leave to take care of sick family members, up to $200 a day of tax credits. If you didn't receive your stimmy money, you can also reduce your taxes by the amount that you should have received instead of waiting for Uncle Sam to mail you a check. With all of these tax credits, you can reduce your tax bill by $5,000 to $10,000 as well. Unlike deductions, however, there's going to be a much lower upper cap for tax credits that you can claim. Pay a professional. If you're making a lot of money or generally have pretty complicated taxes because you run a business, are self-employed, have various private investments, and own real estate, it may be time to call in a professional. While you'll likely pay them $500 or more, they'll also likely be more aware of how to maximize your returns, much more so than you might be able to, having seen hundreds or thousands of different tax situations. Where tax professionals bring extra value is implementing generally accepted tax minimization practices, which may not be fully outlined by the IRS or implemented and captured in TurboTax. For instance, income splitting, say hiring your stay-at-home spouse or children to have more income tax at a lower tax bracket, or setting up an S-corp taxation structure for your LLC to minimize your self-employment taxes. These sorts of maneuvers could save you tens to hundreds of thousands of dollars. Case in point, did you see the article about how the CEO of Match.com moved to Texas and saved $430,000? Basically, he bought a place in Texas, moved his dog there while still mostly working and playing in New York. His yacht was parked in the Hamptons. And paid state income tax for Texas, which was $0. So in total, while we might only have saved $10,000 to $30,000 in taxes through normal deductions and credits so far, when you're stinking rich, the lesson here is hire a great tax advisor, get a dog, leave a paper trail lamenting both your move to a new state as well as praising your new income tax-free state, and profit $430,000, rounding our total tax savings to $500,000. However, for the average middle-class family, moving to a state like Texas, Florida, or Washington probably means tax savings closer to $10,000. Either way, play your cards right, and you could have little to no taxes to pay this season. If you save some money on your taxes because of this video, smash the like button for me and let other people know that they can save that money too. I hope some of you got the reference to the classic Lil Dicky song. I really wanted to add a clip here, but I'm trying to get monetized, not demonetized. Anyways, that's it for this video. As always, appreciate you all for watching my videos, and I'll see you in the next one.